One of the earliest and simplest investments in the business world is purchasing stock in a company. In essence, you are investing money in a company. If that company does well and expands, demand for its shares will increase, driving up the price. You can then sell the stock or benefit from it by receiving dividends to increase your profits. Stocks are accessible to everyone, making them suitable for even novice investors. Let's break it all down so you can understand what stocks are and how you can profit from them. Also known as shares of stock or equities, are units of ownership in a firm. When you purchase a share of stock, you are purchasing a portion of a company's ownership, which entitles you to certain privileges. Understanding what stocks are and how they work is one of the most important aspects of investing, as stocks play a critical part in constructing a well-balanced investment portfolio. Companies sell shares of stock to raise money to support their activities. Organizations invite investors to buy a fractional ownership interest in the company when they sell stock, so becoming part owners. Equities are another name for stocks, and equity is a term used to express ownership. Companies can also issue bonds to raise capital, but purchasing bonds only converts you into a creditor and removes you from the company's ownership structure. Depending on the sorts of shares you own, you have specific benefits when you purchase stock in a corporation, including voting privileges. You could be able to cast a ballot at the annual shareholder meetings of the corporation. Dividends. A portion of the company's profits may be paid to you. Capital appreciation. Your share's worth rises when the company's stock price does, and when the price of a stock declines, the value of your shares fall. While having stock gives you a stake in a company, it does not give you the right to influence how that company runs on a daily basis. When you own shares, you're putting your faith in the company's executives to manage it how they see fit. If you are unhappy with a company's performance, you can sell your shares and look for another place to put your money. When a private company decides to sell stock to the broader public, it has an initial public offering, IPO. When you hear that a firm is coming public, it signifies that they are undertaking an initial public offering, IPO, in which they make shares available for purchase by investors through public stock markets. During an initial public offering, the firm and its advisors reveal the number of shares of stock that will be offered as well as the IPO price. The proceeds from the selling of stock during an IPO are paid directly to the company. Following the completion of the offering, the shares of stock are exchanged on the secondary market, sometimes known as the stock market, where the stock's price rises and decreases based on a variety of circumstances. Businesses offer a wide range of various stock classes. The most popular types of stock are common stock and preferred stock, while some businesses have additional stock classes. These several stock classes define your rights to vote, receive dividends, and recover your investment in the event that the firm files for bankruptcy. Common stock versus preferred stock. Holders of common stock normally have one vote per share at the annual meeting of the firm. When it comes to recovering their investment should the company file for bankruptcy, common stockholders are last in line behind debt holders, creditors, and preferred stockholders. You are normally entitled to dividends if you own common stock, but this is not a guarantee. Depending on their own requirements, companies might decide whether to pay dividends or not. Although preferred stock often allows investors to dividend payments ahead of common stockholders, preferred stock typically does not grant you any voting rights. Preferred stockholders also get priority over holders of common stock when it comes to recovering their investment in the event that the company files for bankruptcy. Different classes of stock are commonly issued by corporations, and they are frequently identified by a letter, such A, B, or C. To aid firm founders or executives in maintaining a greater level of control over the company, Additional share classes are frequently issued with distinct voting rights per class. Consider Alphabet, the holding firm that is the owner of Google. Alphabet offers 3 different stock classes. Each share of Class A stock, GOGL, has 1 vote. The company's founders own Class B stock, which carries 10 votes per share. The purpose of the Class B shares, which are not traded publicly, is to support the founders' continued ownership of the business. Employees and select ordinary shareholders hold the majority of the Class C shares of Google, which have no voting rights. To clarify for everyone what dividends are. Dividends are payments a company makes to share profits with its stockholders. They're paid on a regular basis, and they are one of the ways investors earn a return from investing in stock. But not all stocks pay dividends. If you are interested in investing for dividends, you will want to specifically choose dividend stocks. Types of dividends. Usually, dividends are paid out on a company's common stock. There are several types of dividends a company can choose to pay out to its shareholders. Cash dividends. The most common type of dividend. Companies generally pay these in cash directly into the shareholder's brokerage account. Stock dividends. Instead of paying cash, companies can also pay investors with additional shares of stock. Dividend reinvestment programs, DRIPs. Investors in DRIPs are able to reinvest any dividends received back into the company's stock, often at a discount. DRIPs typically aren't mandatory. Investors can choose to receive them in cash instead. Special dividends. These dividends pay out on all shares of a company's common stock, but don't recur like regular dividends. A company often issues a special dividend to distribute profits that have accumulated over several years and for which it has no immediate need. Preferred dividends. Payouts issued to owners of preferred stock. Preferred stock is a type of stock that functions less like a stock and more like a bond. Dividends are usually paid quarterly, but unlike dividends on common stock, dividends on preferred stock are generally fixed. All types of dividends are taxable. Dividends paid by U.S.-based or U.S.-traded companies to shareholders who have owned the stock for at least 60 days are called qualified dividends, and are subject to capital gains tax rates. All other dividends are subject to ordinary income tax rates. How often are dividends paid? In the United States, companies usually pay dividends quarterly, though some pay monthly or semi-annually. A company's board of directors must approve each dividend. The company will then announce when the dividend will be paid, the amount of the dividend, and the ex-dividend date. Investors must have bought the stock at least 2 days before the official date of a dividend payment, the date of record, in order to receive that payment. The ex-dividend date. The ex-dividend date is extremely important to investors. Investors must own the stock by that date to receive the dividend. Investors who purchase the stock after the ex-dividend date will not be eligible to receive the dividend. Investors who sell the stock after the ex-dividend date are still entitled to receive the dividend, because they own the shares as of the ex-dividend date. The ability to participate in the earnings of the most prosperous corporations in the world is provided by owning stock. One of the most popular U.S. stock performance indexes, the S&P 500, provided investors with an average annual rate of return of 7% between 1959 and 2009, when adjusted for inflation. Stocks have outperformed fixed income assets over the long term, returning an average of 4.67% more than Barclays U.S. Aggregate Bond Index. Investors utilize stocks as one of the main tools to grow their assets and plan for long-term financial goals like retirement and educational funds, even if purchasing them carries some risk. Your savings balance increases along with stock price increases. But keep in mind that stock prices might decrease, perhaps to the point where they are completely worthless. You cannot be certain that you will get your money back.